I'm Sandy Ray, founder of Sandra E. Ray CPA, where we alleviate financial headaches so that you can create a bigger impact. Today, we're going to do a really quick GAAP update and have some reminders for some things that have happened just recently to make sure that you're addressing those in your organizations. Now, there's not been a lot going on with FASB as it relates to nonprofit organizations. There have been a few recent developments, and there are some things out there that you may think does not apply to nonprofits that do apply. So let's get started. Of course, we're going to talk about lease accounting. Lease accounting changes have been going on for years, but I want to address something very specific that can happen within nonprofits. And that's when we have assets that are under lease, but are under also common control. So two entities have control over an item. So I want to clarify some of this common control issues. Issue number one is, if we have something that's under common control, does a lease exist? And if so, how do we account for it? So if a lease exists, that there's documentation that a lease exists under the rules that what is a lease, then we're going to account for it the same way that we would as a lease between parties that do not have common control. That's just the regular lease accounting standards. The other issue regarding common control is if we have leasehold improvements. Now, in a regular lease accounting, leasehold improvements are amortized over the life of the lease, which is the lease term plus any options. Now, if we have common control, those leasehold improvements are actually amortized over the life of the items themselves. The lease does not control the life. And I wanted to make those little technical clarifications available to you. Now, the next thing I want to talk to you about is crypto assets. This update came down last year in 2023, but it is effective for fiscal years beginning after December 15th of 2024. So for calendar year entities, this is effective for you in 2025. So just around the corner. So we want to make sure we're ready for it. Now, we're talking about crypto assets, when to record them, when not to record them, and how to record them. So we're going to record crypto assets when they meet certain criteria. And FASB has set out what that criteria is. The first thing is that they are going to be recorded as intangible assets if they meet this criteria. The first criteria is they're secured through cryptography. And that's a very technical term, but basically they're secured. You have to go through processes. It's not normal data. There is a methodology to cryptography, and they have to be something that's secured by cryptography. The second criteria is that they're fungible, which just means they're interchangeable with other assets of their kind. So you can use the crypto asset to pay for something. You can buy other crypto assets, you can buy tangible assets, that they're interchangeable, that you can use them that way. And for you to record them as an asset on your books, they cannot be created by you or your related parties. So if you've created any of your crypto assets or related parties have, that is not an asset to you. That can't be recorded. Now, when we're presenting crypto assets, we want to talk about our three main financial statements. The first one is a statement of financial position. We're going to put those crypto assets as an asset on our statement of financial position. We're going to put it in a section with other intangible assets, but it is going to be on its own separate line item. Now, the same for our statement of activities. Any gains and losses in fair market value, any net income or expense or losses that we incur, those are also going to be recorded in their own separate line item. So crypto assets, gains and losses is going to be its own line item from other intangible gains and losses. And then finally, on our statement of cash flows, this is where it gets a little tricky. We have to look at the source of the crypto asset. If we've received this in the ordinary course of our business as a donation or payment for program services, and we're generally turning that crypto asset into cash in a very short amount of time, we put those gains and losses in our statement of cash flows in the operating section. So again, it's received in the ordinary course of business, converted to cash very quickly, goes into operating. Anything else is going to go into the investing section of the statement of cash flows, which means we're going to need to have proceeds from sales and disbursements for purchases. Now, I want to talk to you about a not so recent, but it's coming to an end soon, a moratorium on the employee retention credit payouts. I'm going to give you an update. If you haven't heard, the IRS had put a moratorium on processing refunds or credits to employers based upon the employee retention credit filings. And this was due to a surge of fraudulent filings. The moratorium began about a year ago in September of 2023 and is expected to last until the end of this December. Now, this gave the IRS time to process the high volume of claims, focusing on identifying fraudulent versus legitimate applications more effectively. But it also gave time, and you still have time, if you're an organization who thinks that maybe there was an error or something on your claim, you could withdraw that claim and avoid any penalties. And I want to also let that the IRS is working on a settlement for people who received claims that were incorrect, received credits that were incorrect. There's a proactive settlement process that you can go in and get those claims or get that resolved very quickly. And I want to let you know that this is coming from a Journal of Accountancy article that I read. So if you need more details, you're welcome to Google that and you'll get more details on that. Now, going to something that FASB is working on right now, we've got a software cost project. And the thing with software is, do we expense it immediately or is an asset that we capitalize and spread that expense throughout the useful life of the software? So they're currently looking at what we're doing now, what changes need to be addressed. So let's be watching for changes as a result of that project. And then finally, I wanted to talk to you about current expected credit loss. The standard was effective for fiscal years that began in 2023. So this is already going on, but I want to make you aware of it. Many people think that this does not apply to nonprofit organizations, and it does. It applies to our accounts receivable. If you are a community development financial institution, it applies to the portfolio of your loans receivable. It applies to pledges receivable, and it applies to any off-book items like loan commitments and guarantees. It does not apply to grants receivable. It is one of the things that was just carved out. Now, what this says is assets need to be presented at their net amount. And I'm oversimplifying this really. So we're taking what we expect, what is the receivable, and we're reducing it by any estimate of what we think we won't collect. And we're reporting the net amount. The method of calculating this is there's two ways. First of all is the pooled method. We can pool all similar assets together, look at the credit risk over multiple items, and estimate what our allowance for doubtful accounts is. Now, the assumption is that the bigger the pool is, the lower the credit risk, that kind of thing. So that's a great way to do that. So generally, most people are doing that. But you may have individual assets that don't have other assets of similar characteristics. And in that case, you are going to have to evaluate those assets individually. Now, the impact on our financial statements is we're likely to increase the allowances for credit loss. And this can affect our financial ratios, those key performance indicators that we're looking at. So we may want to adjust our benchmarks as well. We want to enhance our internal controls to make sure that the internal controls are addressing that we need an estimate for credit loss. And our audit committee, or whatever committee is responsible for that type of internal control, that those people are looking at, those board members are looking at the calculation of the credit risk and the assumptions that we're using. And then finally, for documentation and disclosures, of course, we're going to have to document how we calculated it, but on our external financial statements with the notes section, we have to disclose the nature of our credit exposures, our estimation techniques, and how our forecasts impact our credit loss calculations. Now, that's just a quick summary of the generally accepted accounting principles updates for nonprofit organizations. Like I said, is very generalized. We just want to make sure that you're aware of the topics that are coming or are already here recently, so that you're making sure that those get addressed in your organizations. If you have any questions on this or other topics, please put them in the comment section below. We're happy to answer those questions. And I hope this was helpful for you today. We always appreciate your likes, and thank you for joining me. Remember, creating a bigger impact starts with stopping the nonsense. If you're dealing with nonsense in your nonprofit organization, we'd love to help you cut through the noise.